Welcome to Close of Business. I'm Nadia Daly. Well, the big four banks and most economists said it was a done deal, but in the end, the Reserve Bank shocked analysts, leaving interest rates on hold at 3.85%. The RBA board was split 6-3 for not cutting rates. The central bank says it's maintaining a wait-and-see attitude on inflation and the economy, despite borrowers clamouring for rate relief, as David Chow reports.
It was a shock decision that blindsided households desperate for mortgage relief.
I wouldn't say cut, hold is whiplash. I would say that sensible, cautious approach to lowering interest rates.
The Reserve Bank left interest rates steady at 3.85%.
There will be millions of Australians around the country who are desperately hoping for more rate relief today. This decision will come as a surprise to the market and to almost every economist who's expressed a view in recent days and weeks.
We did last week change our call to expecting a cut from today, although we said it would be a close call, and it was, just not the call we thought it would be.
The RBA governor was quick to defend communications from the central bank.
The Reserve Bank can't go out and talk to markets and tell them what the decision is going to be ahead of the meeting with the board.
What is the biggest thing that prevented you and your colleagues from cutting rates today?
We don't want to end up having to fight inflation again. We want to make sure we've nailed it.
But Michelle Bullock did give a hint about whether the RBA would cut at its next meeting in August.
There's 5 weeks till the next meeting. By then we will know what the June quarter CPI is, and if it comes in, as we think it will, then that validates our easing path. Which
economists are trying to forecast.
So we expect another cut in August and another cut in November. We think the RBA has enough scope to bring rates lower, but that doesn't mean that the cut rate will become accommodative.
Do you think he can hold this?
Mortgage borrower Chloe Kang hopes rate relief isn't too far away.
Hopefully that means we'll finally be able to plan something fun for the family.
The icy chill from mortgage pressure means some are spending the school holidays close to home.
It's definitely it's a hard. When there was a rate cut, it's make our life easier. We can go out more often. We can go overseas on holiday.
The really interesting thing about this Reserve Bank decision was the division. For the first time ever, the RBA revealed that 6 of its board members voted in favour of rates staying on hold, while 3 of them wanted rates to be cut. As for the RBA governor herself, she refused to say which way she voted.
They're unattributed votes. I won't reveal how I voted. They are unattributed for a reason.
I think this is an appropriate level of transparency.
While the RBA is staying on hold for now, there's a lot of economic uncertainty ahead. Donald Trump is ramping up trade tensions, sending letters to countries across the world, dictating what level of tariffs their goods into America will face.
There will be an impact on us, and that's partly what's driving, I think, some of the deflationary impact in our forecast.
But if global economic growth tanks, or if our biggest trading partner falters, the RBA governor said the central bank is ready to act.
If something really bad does happen, we've got more room to move, and we've got room to move, but we're not deliberately holding interest rates high in order to give ourselves more powder. Thank you.
Taking a cautious approach, not a popular one.
While it was almost a 100% bet the RBA would cut this week, the shock decision has divided leading economists. Alan Oster is the former chief economist for the National Australia Bank, and I spoke to him earlier. Alan Oster, thanks for joining us on Close of Business.
Thank you.
Now, markets had figured a rate cut was in the bag, but they were very wrong, as were most experts. We've had leading economists on the show this week saying it was the wrong call and some backing it. What's your view?
It was a surprise to me. What they basically did was they ignored the monthly CPI and just said, well, inflation's a bit higher. The monthly CPI is a bit of an experimental series, but it does give you implications about where we'll go when you finally get the full June quarter CPI, which is in 2 weeks' time. But to me, I was expecting them to cut.
Critics pointed to the RBA entertaining a 50 basis point cut at the last meeting as evidence the governor hasn't provided enough forward guidance. Is that fair?
I don't think there was ever a realistic 50 basis points discussion. I know it was in the minutes, but I think that was sort of, you can say, oh, we'll do 50 or we'll do 25, but they just do 25. I think the new governor, she's been there about 12 months now, is very keen to avoid any idea about giving forward guidance. Phil Lowe did that, and it didn't get him into a good spot. So they're particularly not interested in trying to say, oh, then don't worry, in the future we'll cut or we won't cut. So I don't think that's a criticism that's valid.
Now, you, of course, were the chief economist for NAB. All of the big four banks were unanimous the RBA were going to cut. How did the banks get it so wrong?
I think the banks just looked at what we've seen in the past. The labour market weakened a little bit in employment, but not unemployment. The inflation data came down quite a bit. And if you'd basically use some of the information that's used in the full quarterly that comes out in the May readings, you'd get a quite low CPI for the core June quarter CPI. So I would expect somewhere around 2.6 to 2.7% growth in the trim mean, and that's really close to their target of 2.5. So if you don't cut now, you know, I think basically what they're doing is buying themselves a bit more time. I think it's almost certain that they'll cut on the back of a low CPI when it comes out in 2 weeks' time. And they'll probably do another one in November. And I would say they want to get to somewhere around 3. And that's most likely, I think, early next year.
Now, the RBA Governor, Michelle Bullock, defended herself against fierce criticism, saying the decision, like you were just alluding to, is about timing, not direction. So in your view, what exactly is the timing?
Okay, so the timing is every second month of the quarter. So that's May, which they cut, February, which they cut. And in August, what you get in that second month of the quarter is their full forecast for going forward. So then they'll be able to say, well, do I really think inflation's not going to get back down to the target any time in the next 2 years, which is their current forecast? I don't believe that's credible going forward. So that's why I think they're more likely to cut, and they'll dress it up on, we've got full inflation data, we've got our forecasts, and our outlook says that we'll be back in the target range, or in the middle of the target range, probably by the end of this year.
Now, heading overseas, the new tariff threats from Donald Trump seem to imply Australia could be copping 15 or even 20% tariffs now. How do you think Australia should play this?
I think we should just do what we're doing. I still expect the 10% general tariff to be employed. I don't expect we're going to get an exemption. We've got a delay till August, but so I'd basically say the direct effects of a 10% tariff is really very small. What you've got to worry about is what indirect effects come from our major trading partners who are likely to get hurt much more than we are, and also what it does to business confidence and, you know, consumer sentiment, because they're the things that essentially could escalate this significantly. And then, of course, Trump's also announced increase in, 50% tariff on copper, which could affect Australia a little bit more, and it's already affected the price of copper on global markets. And then they're muttering about pharmaceuticals and talking about a 200% tariff there, but that doesn't come in for at least 12 to 18 months, and I think it's part of a game which the Americans are trying to play to sort of put some effort on Australia to change the PBS, and I don't think Australia's going to do it. So it's sort of indirect effects rather than the direct effect on the Australian economy, because the direct effects on the Australian economy are very small.
Alan Oster, thank you as always for speaking with us.
Thank you.
Donald Trump's promise of 90 deals in 90 days has come and gone with just a handful of agreements signed. The US president has shifted the tariff goalposts, demanding dozens of countries come to the table by the new deadline of August the 1st. Now Mr Trump is threatening 200% on pharmaceuticals, with major companies like CSL on the front line. Emilia Terzon has the story.
President Trump announces new tariffs
against dozens of countries,
expanding that trade crackdown.
Another day, another tariff announcement, upending global supply chains and confusing companies.
This is something that we have not seen for many, many years. So the world is changing.
We're all watching this like hawks.
After tariffs on steel and aluminium, Donald Trump has another key manufacturing component in his sights, impacting both Rio Tinto and BHP.
I believe the tariff on copper, we're going to make it 50%.
50%. And the idea is to bring copper home, which is key to the industrial sector, back home to America, likely to be put into place the end of July, maybe August 1st.
The Trump administration is also planning to slap tariffs on one of Australia's biggest exports to the United States.
If they have to bring the pharmaceuticals into the country, they're going to be tariffed at a very, very high rate, like 200%.
We are in this era of the new protectionism, mercantilism. There's a winner and there's a loser, and the United States wants to make sure that they control these strategic supply chains.
Some countries are getting letters about new levies taking effect in August, including key manufacturers like Japan, South Korea and Indonesia. More letters are being sent to other nations, including the EU.
We're probably 2 days off from sending them a letter. I just want you to know, a letter means a deal.
And with that, there is new revenue for the US.
So we could expect that could be well over $300 billion by the end of the year.
The US Federal Reserve isn't so sure, and it's been sounding the alarm about inflation. Here in Australia, our central bank is also watching closely.
The situation is evolving very rapidly. The day after Brexit happened, everyone thought the world would end, and it didn't. But 10 years on, you're seeing the profound effects of some of those changes for sustainable growth rates and for fundamental things in the economy.
Here in Australia, the latest tariffs on pharma would mostly impact CSL, which sends blood products like plasma to the United States. It already has operations here, and the company says that it's monitoring the situation closely.
We'll continue to engage with our counterparts in the US on these issues. We'll continue to engage with our own exporters and industries to work through the potential costs and consequences of what's being proposed.
Local copper miners would also be impacted. The chief executive of Cyprian Metals says he's rolling with the punches.
There's a lot of protectionism. There's a lot of two-speed markets. There's a lot of politics in the commodities markets right now, more than at any point in time in my career. So these tariffs, I think, are really interesting because it just is a signal of how important copper is.
Globally, companies selling items as diverse as luxury watches are also trying to stay calm.
I think the 31% is posturing and it's a threat, and it's just to get people to the negotiation table.
There has been a little bit of a cliche going around that Donald Trump should be taken seriously but not literally. I think we do have to take him literally.
As the world watches and waits for his next move.
Qantas has confirmed details of compromised data includes addresses and membership tiers, including to the exclusive Chairman's Lounge. The airline has promised to send updates to the almost 6 million affected customers who cyber experts warn will be targeted by scammers. Business reporter Rihanna Whitson has been covering the story. Rihanna, remind us how this cybersecurity disaster all happened.
Well, this cyber attack came to light on Wednesday of last week when Qantas fessed up to reveal to customers and the market that it had fallen victim to a major cyber attack. At the time, Qantas said that it had detected unusual activity on a third-party platform used by one of its call centres. It detected that activity, it said, on Monday of last week. Now, what we do know is that far from a sophisticated attack, what's happened here is that cyber criminals believed to be from the group Scattered Spider simply called up a Qantas call centre in Manila and tricked a staff member there into handing over the credentials to the third-party platform that held the customer information of about 6 million customers.
What have we learnt this week from the airline, and what do we know about how customers have been affected?
names, email addresses, birth dates, frequent flyer numbers, points, even things like membership tiers and meal preferences have been caught up in this breach. Now, some customers have been told that basically all of the information that was contained on this third-party platform is now in criminal hands. Let's have a listen to what Qantas CEO Vanessa Hudson had to say in response to this data breach this week.
I am accountable for this, and we will make sure that we see through to the end, learning and making sure that we lift the controls in our system.
Now, this is the first major disaster for the airline with Vanessa Hudson as CEO. How's she handled this?
Well, that depends on who you speak to. Last week we had the relevant federal government minister, Tony Burke, come out and say that basically he didn't have any issue with the way that the airline had responded to this. Now, as some commentators have pointed out, that sits in pretty stark contrast to the way that the federal government reacted to the Medibank and Optus data breaches. Now, Quantis itself, it pretty much went to ground for a couple of days after this data breach. Dozens of customers have contacted the ABC, very frustrated and concerned that this data breach exposes major flaws in the way the airline manages their information. We've spoken to governance expert and Qantas customer Andy Schmulo, who has also been caught up in this debacle.
What we need is legislation to hold executives like Vanessa Hudson personally accountable for these kind of data hacks, and we need an information commissioner which is willing and able to enforce the law.
Now, we don't know whether it's received a ransom attack, but experts say if it doesn't pay a ransom, then it's very likely this passenger information is going to end up on the dark web.
Thanks for the update, Rihanna.
Thanks, Nadia.
Nvidia investors are laughing all the way to the bank, with the Silicon Valley chipmaker becoming the first publicly traded company to surpass $4 trillion. The staggering valuation is being driven by the artificial intelligence boom, powered by Nvidia's industry-leading processors. The AI bellwether is now worth $900 billion more than Apple, which was the first listed company to break through $1 trillion. To the share market, which finished the week almost where it started. The ASX 200 and the All Ordinaries ended the 5 trading days down just a few points. I spoke to Capital.com analyst Kyle Rodder from Paris to wrap up the week. Welcome to the program. Tariff D-Day of July 9th came and went, and now there's a new deadline with a raft of tariff threats. Given there was a bond revolt in April, why are markets ignoring this now?
Well, I think it's basically the taco trade, which is Trump always chickens out, or if you want to take a slightly more sympathetic view of what the US president is trying to achieve, and that is it's a negotiating tactic. So effectively, the markets are calling the bluff here, or calling a bluff on the Trump administration once again, and more or less pricing in that these tariffs, as they're being announced or threatened over the last few days and going into August 1, won't actually be slapped on in full. And I mean, I think the evidence for that is that if you look at some of the tariffs slapped on Japan and South Korea, notwithstanding some lower tariff levels for places like Europe, these countries are being exposed to tariffs similar to or, above the tariff rates that were announced in April. So in principle, we should really be seeing markets basically pulling back on this kind of a news, similar to what we saw in April. So effectively, this is the markets calling a bluff once again, pricing in that we won't see tariffs at these sorts of rates, maybe in the sort of low teens as an aggregate level for the United States, but certainly not in the sort of, mid 20% range. And therein lies a risk that if we, do see the Trump administration slap tariffs on it, somewhere around these levels, there's a lot of good news to price out of the markets here.
Other big story was Bitcoin hitting a new record overnight of $116,000. Is this an example of the cryptocurrency becoming a bit of a new safe haven asset?
There's actually a reasonably strong argument to be made for that. And I go back to somewhere around the middle of March, to say the middle of May, when we did see significant volatility in equity markets, especially in US tech stocks, which Bitcoin has tracked traditionally quite closely, and the stability that we saw in Bitcoin in that time. Now, we could be speaking far too prematurely and, maybe still like in the past, Bitcoin is maybe some kind of measure of market sentiment, market liquidity as well. But if you do look at Bitcoin's behavior and even some of the kind of mainstream adoption that we are seeing from investors by buying Bitcoin as a little bit of an alternative, the evidence is starting to stack up that maybe there is another case being built for it, and that is effectively what it was supposed to be initially, a hedge against sort of fiat currency, maybe a hedge against the US dollar too. US dollar assets have probably come into a little bit of a crisis of confidence because of fiscal and trade policy over the last few months. So I wouldn't necessarily want to draw a line under it yet, but there's very interesting evidence that kind of points to the fact that maybe Bitcoin is now behaving a little bit more like a source of a hedge, or at least a source of safety.
The Aussie dollar's hit a 9-month high, just shy of 66 US cents overnight. What's behind that?
Well, of course, we had that surprise rate hold from the RBA, but I think most of these drivers for the Aussie dollar at the moment are international in nature, and really it's down to some US dollar weakness. Again, we're talking about investors looking for alternatives before. The dollar is really weakening on the basis that investors are looking to diversify themselves away from the US dollar and US dollar assets because of this kind of de-dollarization narrative that's been brought about by some of the Trump administration's policies, or at least accelerated by some of the Trump administration's policies. There's also kind of a cyclical story in the United States where the US economy is converging with the rest of the world. And then not only that, the Aussie dollar is probably a little bit of a manifestation of a bet that, global trade and global growth, although it's likely to weaken going forward because of trade policy uncertainty, isn't going to be quite as bad, or the slowdown in global growth won't be quite as bad as previously feared. So there's a multitude of factors kind of driving the Aussie dollar at the moment. Mostly it's international in nature, but you've also got sprinkled in there too, that RBA hold this week as well.
Kyle Rodder, thanks for joining us on Close of Business.
Thank you.
A growing number of small business owners are staying afloat during tough times after getting their creditors to forgive huge levels of debt. It's legal thanks to new restructure laws, and overwhelmingly it's tax debt that's been wiped. The corporate regulator says there's no evidence the laws are being rorted, but some still have reservations. Here's Emilia Terzon again.
In the tourist town of Albany, this heritage-listed pub stands the test of time, having served patrons now for nearly 200 years. Its current publican, Neville Walton, took over the lease 8 years ago.
This is my first and last hotel venture, so something I thought I'd take on when I turned 60 was to buy a pub. Here we go. Cheers, thanks, mate.
Neville says that business was good at first, but then patrons dropped during the pandemic and his costs like electricity, wages, even beer started rising. Paying the bills like GST came last.
Thought, the tax department can wait a bit longer, and of course it grows, so it just blew way out of proportion.
The situation became so stressful that Neville thought about using his super to pay off the debt, or even calling last drinks on the business.
I was getting very close to that, just keeping my head above water.
Then Neville heard about a way that small businesses can wipe lots of their debt.
This is designed for small businesses. It allows the directors of the company to develop a restructuring plan with an assistance of a registered liquidator.
Companies can only do this if they're less than $1 million in the red and none of it is cash owed to staff.
It's ultimately a decision of the creditors of the company whether or not to accept the plans, and if they approve it, then that plan sort of resets the company, including the debts that it owes, so that it can continue to trade afterwards.
3,000 small business restructures were lodged last financial year. Construction companies are lodging the most, followed by hospitality and accommodation. 34% involved debts between $200,000 and $400,000, with businesses on average asking for 79% of this to be wiped. Almost 9 in 10 restructures went through.
The ATO is the largest creditor in most small business restructures, and that means that they control the voting. If they say yes to the SBR, then it will go through.
Jarvis Archer helped Neville Walton with his pub's restructure. It proposed paying the tax office back just $76,000 of almost $350,000 owed, plus a $15,000 fee to Jarvis's firm.
Now, the good thing about his business, he's returned it to profit, showing that it's viable, and it's been paying the ATO the whole time.
Nice and frothy.
The tax office said yes, striking a deal for the Albany Hotel to pay back just 22 cents to the dollar of what it owed in monthly instalments.
You know, I'm retirement age, and so hopefully in the 18 months' time I can come out of it debt-free, and although I won't have anything to sell with the business, I'll be able to sleep at night.
Most of the companies that are going through these restructures are still registered within the next year, but beyond this, there is very little data about the long-term success of this policy and whether it's encouraging good business or simply wiping debt.
There's some downside there where it can be utilised to avoid paying debts. For example, you know, if you're paying 10 cents in the dollar on your debts to continue trading, not necessarily a sustainable model for most creditors.
The corporate watchdog says that it's found no evidence that these restructures are being misused or encouraging practices like phoenixing.
We are monitoring the data, but there's no guarantee that that company or any of these companies are going to always be successful afterwards. The only thing I can say is that they can't do it in a serial way, because there is that rule that says that you can only use this restructuring process once every 7 years.
Back in Albany, Neville is still behind the bar 6 months after restructuring his business.
Cheers to the tax office, thank you.
Neville hopes to retire in coming years.
And that's all from Close of Business. I'm Nadia Daly. Thanks for watching.